Good afternoon, everyone. My name is Errol Zeki. I'm the Chief Executive at Sasfin Wealth. So on behalf of Sasfin and UBS, I'd like to welcome you to this webinar. It's titled Different Recoveries at Different Times. At Sasfin, we took a view some time ago that to truly grow and protect our clients' wealth, we need to take a truly global view on investments. We couldn't just rely on local markets. It's been a hugely successful strategy for our clients, and with that, it's been a very successful strategy for our business. Our success in this instance and every instance is very much aligned to that of our clients. And Sasfin Wealth and UBS have a partnership going back really to the beginning of this journey, and we continue to build on this association. So today's speaker is Paul Donovan. He is the Global Chief Economist at UBS Global Wealth Management. We've hosted a number of Beyond Global Wealth roadshows over the years, and for those of you who have attended these national events, you may be familiar with Paul if you've attended some that he's been present at. He's been part of several of them over the years. And if you read the invitation to the webinar, you would have seen that Paul believes passionately that economics is something everyone can and should understand. And there's one quote of Paul's that I think I've used at every introduction that we've done so far. But Paul has said to me, and I've seen this quoted elsewhere, we all make economic decisions all the time. The problem is that economists tend to wrap economics in jargon and equations. We do not need to do this. It is his job to help people realize what they probably already know by developing and explaining the UBS economic view in a clear way. During this presentation, may I ask if you have any questions, post them to the chat function. Paul, if you're comfortable, what I'm going to do during the session is to try and collect all the most common ones, group them together, and I'll present them to you at the end of the presentation, or the end of the formal part of the presentation. It's great to see you again, albeit virtual this time. So thank you for joining us once again. Really look forward to hearing your insights. And as always with that, Paul, I'll hand over to you.
Thanks very much, Errol. And hello, good afternoon, everybody. So I'm going to try and go through what's happening with the global economy, how policymakers are going to react over the course of 2021, and perhaps flag up one or two longer-term structural issues that we're also going to have to be thinking about, because we don't just have the disruption of the pandemic, we've also got a lot of structural change going on in the background, and some of that's being accelerated by what we're seeing around the pandemic at the moment. So what we have seen over the course of the last 6-7 months or so is that financial markets have continually been surprised by the strength of the economic bounce back and by the speed of the economic bounce back. Time after time, economic data is coming in better than the market has been expecting. And what we've also been seeing is that the previous data releases are being revised up all of the time. Literally every German data release is being revised positively these days, but most countries are also revising up their data. And I think this is important to bear in mind, because there's a reason behind this constant positive revision. And that is that in 2020, we didn't have a recession. There wasn't a recession in the global economy. We lost a lot of GDP, but it wasn't a recession. Now, recession actually isn't a proper economic term. It's one of these made-up media words used to sensationalize everything. But we all sort of know what a recession is like. There's some kind of imbalance in the economy, and it all goes a bit wrong, and GDP slows down, and then you sort out the imbalance, and then gradually over a period of time, confidence is restored, and the economy claws its way back to trend. That's the typical sort of recession recovery phenomenon. That's not what happened last year. Last year, governments shut down the economy, and then a few months later, they partially opened the economy back up again. So when we look at the economy, for sections of the economy, quite large sections of the economy, we didn't have this sort of normal recession and then gradual recovery. No, what we had was basically an extended version of what the French call grandes vacances. as many of you are probably aware, the French, rather sensibly, decide not to work at all for most of the month of July and all of the month of August. The country basically shuts down apart from bars and restaurants. And so what you have in France is a period of time where you're working normally, everything stops, and then come September, everything goes back to normal. It's not this sort of gradual recovery. It's like turning a light switch off and then on again. And that's exactly what happened, for example, with the manufacturing sector globally. And so we have had a far faster recovery, and in things like the labor market, very sudden, surprisingly strong improvements in employment, etc., etc. And so that means that we have been trying to cram the 2020 experience into a classic recession recovery model. And that's what statisticians have been doing, and it's what some people in the markets have been doing, and it just doesn't fit. And so we've had this continual surprise, and I think we're going to carry on getting these positive surprises as we go through this year. However, the pattern of growth does differ from country to country, and the pattern of growth is also going to differ with regards to sectors of the economy. And that's going to be a very important story in 2021. So when we're looking at the pattern of growth, the important thing to remember about the virus, we've been saying this right from the start, the virus itself doesn't matter, economically speaking. It's not powerful enough to matter, frankly. What matters is fear of the virus, because that changes consumer behavior, it changes company behavior, and it changes the way that policymakers have reacted. Now, that means that we've got to be very careful in just looking at case numbers or something like that and judging what's going to happen to the economy, because it's more about the fear level than it is about the absolute number of people in hospital or whatever. And if I look around the world today, I would argue that the fear level in the United States is lower than it is in Europe and the UK, for example. Now, we can argue about whether this is sensible or not, but the fact is there's a lower level of fear. Americans are more willing to get on a plane. They're more willing to travel. You know, I've been stuck at home on the farm for almost 12 months now. This is week 51 of me being locked down at home. I haven't been on a plane since March of last year. It's remarkable. But in the States, you're traveling, again, normally you're about 50% capacity on planes. In the United States, several state governments who are in charge of the regulation have been easing regulations, and they've eased for some time, certainly relative to Europe, where actually we're seeing a tightening of restrictions. France contemplating a complete lockdown of Paris, for example, for 3 weeks. So you're starting to see a divergence here, and that's showing up in the economic data, because in the United States, you can go out and spend money. Now, you can't go out to bars or sporting events or to entertainment. That's still generally restricted, but you are able to leave your home and go out and spend money. Here in the UK, I'm only supposed to leave the home for essentials, so buying food and so on and so forth. So with that, the US consumer has been stronger in the first quarter of 2021, whereas the European and the UK consumer are not able to go out and spend in the normal way, and so they are saving money, delaying their consumption, while Americans are out spending their money and gradually reducing their savings. And that gives the US a stronger start to the year. Now, when we look at Europe and the UK, we shouldn't get too pessimistic. Yes, consumers are constrained, they're not spending normally, but they have learned to adapt. And this is one of the things we always see being underestimated. People are very good at adapting to difficult circumstances. They can adapt in the face of a crisis, and that's what's happened. So what we've been seeing is people shifting to online consumption, for example, changing their habits and their patterns of consumption. I remember back in March of last year, having some very difficult telephone conversations with my mother, trying to explain to her how to order her groceries online. My mother is not a fan of technology. She doesn't even follow me on Twitter. Now, every week, my mother is ringing me up with a list of the online price discounts that she's found. My mother is a big fan of price discounts. My mother has completely changed her spending habits. She's adapted in the face of adversity, and of course is likely to continue with her new habits, particularly if there are price discounts. But you see here that the damage that is done from this set of restrictions is a lot less than was the case 12 months ago. So what I've got as a first difference is that in the States, people are out spending money, buying goods. In Europe, we are spending money, but it's certainly more restrained because you do have that physical prevention still in place. As we move into the second quarter, vaccines continue to roll out. In Europe, we will start to see restrictions ease, fear levels will come down, and the European consumer has got an extra quarter's worth of savings vis-a-vis the American consumer that they can go out and start spending in the second quarter. But this is where the second distinction comes in, because at this stage, we are still talking about spending on goods. People are not able to go out for spending on services. You're not going out for restaurant meals, etc. You're still seeing predominantly spending on goods. Because of this, the global manufacturing sector has now completely recovered from the pandemic. We have completely reversed the loss of manufacturing output during the pandemic. And manufacturing is above 2019 levels in the global economy. Now, this, of course, is extremely important for the Asian economy, because Asia, or China, is the world's largest manufacturing nation. Asia is the world's largest manufacturing bloc. And if you are seeing people shifting their spending away from services and towards manufactured goods in Europe and the United States as the main consumers of the world, then Asia is going to get a benefit by selling into that manufacturing demand. And we see that with the export numbers. There are some problems with this. Long, complicated supply chains have been disrupted, and occasionally there are shortages of parts. You may be aware, shortage of microchips at the moment. So you do get some disruption with this, but the general story is of manufacturing demand supporting exports from Asia. And that continues to be a big support for that region in the first half of the year, which is actually just as well, because domestic demand in Asia has not been as strong as it has in Europe and the United States, mainly because of the less adequate social security system that exists in much of Asia. So you haven't got quite so good a domestic demand story, but the external story, the export story, is going great guns in Asia. All of this, I think, carries on until we get to a certain level of fear. As fear continues to decline, as vaccines continue to roll out, at some point, restrictions will ease and people are going to want to have fun. Now, having fun does not involve buying a new washing machine. That really is not a fun pastime. Having fun means going out, socializing, having a meal out, and then posting photographs about it on Instagram afterwards. No one posts photographs of their new washing machine on Instagram. It's meals out with friends or holidays or drinks or whatever. With that, we are going to see a shift from spending on goods to spending on services. And that shift is going to sustain the recovery in the second half of the year. So what we are going to be seeing is, again, a real shift, that the first half of the year has been mainly about spending on goods, but the second half of the year is going to be primarily shifting towards service sector spending. That will challenge the Asian growth model. Asia needs to get its domestic demand in order in order to be able to carry on with growth as that international demand fades a bit. There's plenty of time for them to do that, but that's an important thing to watch for. We will see an acceleration of growth in European countries and the United States, which are more service sector dominated. And alongside that, we should also see further improvements in terms of the labour market. Because, of course, the service sector is very, very much focused on labour. You know, the long, complicated global supply chains for manufacturing, they're a mixture of capital and labour. But you know, restaurant spending, bar spending, entertainment, this is primarily labour spending. And so if you're going to see an increase in demand for services, it will generate an increase in employment. So that's the pattern of growth that we've got coming through, I think. What about inflation in this environment? You know, there's been some concerns about inflation maybe rising. We're getting all of this stimulus coming through. What we've got to remember is that the stimulus is being spread out, and there is a reason we have this stimulus, which is the economy just suffered an enormous blow in 2020. So, you know, governments were taking money away from you by telling you not to work, telling companies to close. Governments basically were giving some of that money back. So we shouldn't, you know, underestimate the damage that was done and the need for stimulus last year. However, as we go through this year, we are going to see a spike in inflation in year-on-year terms during the second quarter. Now, this is because of oil prices. You may remember that in April, May of last year, the oil price went very, very low. On some measures, it went negative. And that translated into low oil prices in the consumer price inflation basket in April, May, and June. Now, oil prices are back to more or less normal. So that year-on-year comparison, April, May, June, is going to be very strong. So we'll get a high year-on-year effect. US inflation could easily go over 3% on headline consumer prices. Core inflation, which excludes food and energy, will also go up because oil is in CPI excluding food and energy. Now, that sounds strange, but it's because, of course, it's embedded. Every time something is delivered to your house, there's a delivery cost involved, which is oil-based. So transport, travel, delivery times, all of that's wrapped up in the core inflation numbers. So core has a smaller role for oil and energy costs, but there is still an oil energy cost element there. So both core and headline will go up, but it's only going to last 3 months. And central banks know this is happening, and they know that by July, the comparisons will be different. It will drop out of the equation. It will be far less of an issue. So we know that this is only a temporary effect and it will fade over time. So I don't think this is something that's going to be a cause for concern. What about the increase in demand? Well, this is where the shift from spending on goods to spending on services becomes particularly important. Spending on goods, we have seen some goods prices rising because, as I've said, there's been disruption to supply chains, limited supply, increased demand, prices will tend to go up. But with the service sector, where supply can respond a lot more quickly to a rise in demand, and where there are plenty of people out of work, ready to go back to work, I think the supply reaction is a lot less likely to produce a rise in inflation for service sector. So as we shift back to spending on the service sector, I think the spare capacity in the economy really comes into its own. Also worth noting that in many economies, we have seen an absolute explosion of new business creation since August of last year. In the US, in the UK, France, Germany, Singapore, Japan, business creation numbers are through the roof. I mean, absolutely nothing like this in history. We're talking sort of 40% year-over-year growth in business creation. It's astonishingly strong. And a lot of this business is actually service sector focused. It's all small businesses, and it seems to be businesses in the retail space and in entertainment and in transport. So what's going on here? What I think's been happening is people have been sitting at home in lockdown, or they're working from home, they're not commuting to the office anymore, they've got spare time, and they're wondering how to fill that spare time. And thinking, well, I've been making hand-knitted sweaters for the family for years, why don't I start selling them online? And they set up an Amazon marketplace or an eBay account or whatever it is. Or they decide that they're going to try their hands at catering, or maybe look at opening an Airbnb once things have settled down. And with that, we've seen this explosion of very small businesses, but it's increasing supply. So we are becoming more subject to supply growth as the economy normalizes, and these micro businesses that have been set up really start to come into their own. Of course, they're not all going to survive. There'll be failure rates and so on. But given just how dramatic that increase in business creation has been, I think that's where we're going to go. So how are policymakers going to react in this environment? I've got pretty good growth with the potential for positive surprises, and I'm looking at a relatively benign inflation environment. After the spike in the second quarter, inflation will be a bit higher than it is today, but it's not going to be high inflation. We're still talking perfectly contained inflation. In this situation, I think monetary policy, that is to say interest rates, is just going to be unchanged. Central banks are just not going to even hint at changing policy interest rates for the time being. However, I think that the bond buying program will be a topic for discussion in the second half of this year. Some central banks, the Bank of England, for example, may actually end the bond buying program earlier. But for the Fed and the ECB, I think they're not going to end the bond buying program this year. But as the economy recovers, as the need to keep pumping in liquidity fades away with that recovery, then I think central banks will be inclined to scale back their bond buying. And so there will be discussion about that in the second half of the year as the economic recovery becomes established, and then implementation, I think, in 2022. So a relatively accommodative central bank position. What that then translates to into financial markets, I think, is still an environment where effectively central banks are telling you to take risks. Absolutely, aspects of the market are stretched in terms of valuations. This isn't like it was 9 months ago when it seemed to us very obvious that equities were going to be rising. But I still think equities probably outperform as an asset class here because the growth story does remain very good. And the alternatives, government fixed income, are not going to be offering attractive rates of return in this very low interest rate environment, which I think continues for the foreseeable future. So it is still, for me, an environment that is probably broadly risk on. Finally, though, I think we do have to give some consideration to the longer term and some of the changes that are coming through. These are changes that were in play already, what economists call the fourth industrial revolution. This is robotics and automation, digitization, things like that. These changes are very profound. It's called the fourth industrial revolution because it really is revolutionary. It's really dramatically changing the way society operates. And the pandemic has accelerated, I think, a lot of this. Things like working from home, online retail, these are changes which may adapt somewhat in the future, but we're not going to go back to the way that we were working in the past. I think that this is the new way of doing things. We were already moving in this direction. A lot of people get very excited about technology in this sort of environment, say, well, it's the technology that's the future. Technology is probably the least exciting thing about this, because it's not the technology that makes the difference. It's how we use the technology that is really going to be making dramatic change in the economy. So think about this. Here am I working from home as I've been doing for almost a year. I'm able to work from home because of technology. A laptop that I bought 3 years ago, a webcam I bought 2 years ago. That technology allows me to do my job from home. But what's revolutionary is not the fact that I bought a laptop 3 years ago. What's revolutionary for the economy is the fact that I'm not in my office in London. I am now working from home. That's changing demand for real estate. UBS doesn't need to provide me with an office anymore. It's changing demand for office equipment. UBS doesn't have to provide me with computer equipment. They expect me to provide my own equipment to do the job. Once again, I am subsidizing UBS shareholders. I am no longer traveling to work. My morning commute is me stumbling 10 meters from my bedroom to my home office. I'm no longer buying an overpriced sandwich from Pret-a-Manger. I'm making my own lunch in the kitchen here using ingredients bought from the local village shop. You can see here we're making profound changes to things as far removed from technology as food distribution and real estate. And yet those changes are going to be very dramatic, very significant, changing employment patterns, changing real estate prices. This is exactly the sort of disruption that we're going to be seeing. I think that this is going to be the really important focus as we get beyond the summer. Once we get beyond that initial, let's go out and have fun and party over the summer, this is going to be what matters. Because we need government policies which are not trying to boost the economy in a cyclical sense, but tackle some of the structural issues that are now being accelerated. Deal with the fact that there are dying industries, department stores, things like that, where there is no future, but there are people working there. How do you transition them into growth areas of the economy? How do you smooth out this process? How do you change your plans for infrastructure and economy? Where do you put your transport links? Where do you prioritize your technology? And so on and so forth. And that, I think, is going to be one of the more interesting areas over the course of the next few years, and something which potentially, I think, offers a great deal of interest to investors as we contemplate what's really a rather exciting shift in the way the world economy works. Why don't I stop there? But I'm happy to take questions, Errol.
We do have a few questions. So firstly, you did speak quite a bit about inflation through the presentation, but we've just seen just in the last week how violently markets react to just a hint of possible inflation. So we've had a few questions coming through. Some were sent before the webinar, and some have come through the chat, specifically around inflation. If it spirals out of control, what does that mean? And I think some of the questions also then went back to what does it mean for relative asset class relationships, particularly equities and bonds in different inflation scenarios?
Well, the problem with inflation is it's not a single concept. There's lots of different forms of inflation, and you need to ask, well, what sort of inflation do we have? Why is it coming about? If it's coming about because central banks have lost independence, which I don't think is the case, but if it comes about because central banks have lost independence, then you've got a very negative environment for fixed income, because you will then be looking at an inflation uncertainty risk premium. If central banks can't be trusted anymore with inflation, then you're not going to lend the government money and say, okay, well, I want a real yield of 2% and inflation's going to be 5%, so give me 7%. No. You're going to say, I want a real yield of 2%, inflation's going to be 5%, but I don't trust the central bank, so I want an extra 2% on top of that as an insurance premium. And that then keeps pushing up real yields. And obviously for an existing holder of government bonds, that's a very negative scenario. But that rise in real yields is also very destructive to growth, because you're raising the cost of capital in real terms, not just for the government, but for the whole economy. Because anyone you lend money to, you're going to want an inflation uncertainty risk premium built in. And that then becomes a very negative scenario. If you are getting a rise in inflation that is caused by an economy that is performing very strongly, then that's a somewhat different scenario. That's still relatively negative for the fixed income markets, but that's potentially more positive for equities as an asset class, as a hedge against inflation. Because in that scenario, then you are not talking about growth being undermined by an inflation uncertainty risk premium because you don't trust the central bank. You're saying, no, we've got a temporary spike in inflation caused by very strong demand. Yes, the central bank will rein it in over time, but in the meantime, that means very good earnings growth. And so you then create a more positive equity environment, one where equities are a better hedge against inflation, though where fixed income is still generally going to be underperforming. And then if you get something like the spike that we've seen, that we're going to be seeing in the second quarter, that's something which doesn't really affect asset classes at all. Except I think that you will get some volatility in the markets, because although I know that this is coming, although central banks around the world know 100% this is absolutely coming, and in theory the markets know this is coming, the reality is markets still react a little bit because they don't listen to economists as often as they should, and so there'll still be a little bit of a surprise, even though this is a completely predictable event that's coming through. But that's just a temporary issue, and you basically need to look through that and say, no, this is not going to last. What we've seen in the last week, in a small part, was about inflation. I actually don't think that was the major part. There's been quite a lot of movement in terms of expectations about what the US government's going to be doing with its reserves held at the Federal Reserve. That's caused some disruption to the short-dated government bonds and so on and so forth. So what essentially has been happening within the US fixed income and financial market system, money market system, is a process of adjustment to face up to a more active government in the economy, not just because of the forthcoming fiscal stimulus, but just because basically the US government raised a lot of money and hasn't got round to spending it, and now under the new administration is getting round to spending it. And that's caused just some technical disruptions which rather exaggerated the moves, which is why this week everything's calmed down so significantly. We haven't had any major Fed speeches. We haven't had any major inflation data come out or anything like that. But the situation in the markets has calmed down. The technical factors have become less distorted, and we've settled down a bit in terms of bond yields this week.
Another one that came through was you spoke about a number of changes. You talk about going to your local village to buy groceries, not needing your office in London and all those types of things. Which of these changes or trends do you see as permanent shifts, and which do you think will disappear? So, and where do you see it becoming part longer term of the economy, or larger players in the economy longer term as the effects of the pandemic settle?
I think there are three big shifts in the fourth industrial revolution, all of which have been accelerated by the pandemic. So this is a move to online retail, a move to more flexible working arrangements, and a move to localizing production. These were going to happen anyway. They, in some cases, were already happening at an accelerated pace in certain economies. So South Korea and the UK were already relatively advanced in terms of online retail. About 20% of retail sales were online before the pandemic. The move to home working, again, the UK had already started to move down that route. Basically because the structure of the UK economy means 45% of jobs can be done from home, and real estate here, as you know, is very expensive. So there was a double incentive to start that shift. But that's obviously been accelerated. I'm not saying we're all going to work from home all of the time, or all going to shop online all of the time. That's not the case. But I think that there has been a structural shift. And what's driving this is essentially efficiency. The average office desk before the pandemic was occupied 24 hours a week. That is a monumental waste of resources, waste of real estate, waste of office equipment, waste of electricity. I mean, it's just, you're burning money if you're only using your assets 24 hours a week. Now, we're not going to use our office desks, 5 days a week or 7 days a week, but maybe you could use it 3 days a week, and just think about the extent of efficiency that you get by using it 3 days a week. And of course, all that's happening is that rather than my home office sitting entirely vacant 5 days a week, I'm now using my home office a lot more effectively as well. So the economy is becoming significantly more efficient. Similar sort of thing with the shift online, that I don't think high street retail disappears. It will still be there, but it will be smaller. Shopping as a leisure activity, destination shopping, that will continue. People will go to artisan shops. They'll treat it as a special occasion. You go out and buy something specific and probably relatively high end. I'm pretty sure my teenage nieces are desperate to get back to the shopping mall as soon as they reopen. So there's shopping as a leisure activity, but the mundane, the boring sort of shopping, people are going to do that online. And that again is more efficient because you don't need huge amounts of floor space for display. You are, packaging everything up. Your display is on a computer screen. Global trade is something which is also, I think, going to change and is being accelerated by this process. But this is going to take a couple more years still. So the issue here is that the globalization of the third industrial revolution, essentially the globalization that began in the mid-1970s, is essentially about chasing low-cost labor. But in the fourth industrial revolution, labor becomes a lot less relevant because you use robots instead of labor, in which case you start to produce closer to the customer base, because after labor costs, and if you're getting rid of labor costs, what's your next cost? Your next biggest cost is waste. And it's waste because of inventory waste. You've misjudged consumer demand. Takes 6 weeks to ship goods in from Asia, so you've either not got enough goods or you've overordered. Well, now we're talking about making clothes or furniture or whatever close to the customer, where you're almost producing on demand. And the labor cost isn't a problem because you're doing it with robots and automation and a very small number of people. So that then also becomes a lot more cost effective. Now, the thing here is you can't do this overnight. These long, complex supply chains can't be unraveled overnight. And we saw that with President Trump's trade taxes in September 2018, when he put trade taxes on a large number of Chinese imports. What we find is that China lost about 25% of its market share in the United States, where production shifted from China, not to the United States, but to Mexico, Korea, Vietnam, Taiwan. So there was a shift in production for about a quarter of what China was selling to America. But for 3 quarters, there was no shift in production at all. Now, these taxes were high. And what, of course, happened was where production facilities already existed, you shifted your trade immediately. And where production facilities didn't exist, you just had to carry on. We don't yet have the localized production facilities that will allow these structural changes. It's going to take 2, 3, 4 years to build those. So we're going to be localizing slowly, I think, over time, rather than a sudden rush. But that localization probably happens over the next 5 years rather than the next 15 years.
Thank you, Paul. The next one's a slightly more sort of specific question. I'm just going to read it directly. I think you probably see it on your screen there as well. The one that says, will sector rotation outperform the long-term secular winners, i.e., do we sell Microsoft and buy Boeing?
So I can't comment on specific stocks. Teams of lawyers will come and drag me away if I attempt to do so. But I think that the secular story is shifting. And so the sector rotation, in actual fact, I think is going to reflect some of that. So, for example, when we are looking at technology, as I said, for me, it's not about the technology anymore. It's about how we apply the technology, how we use the technology. That's where the real disruption comes in. Now, disruption, of course, entails losses, but it also entails potentially big gains. And so this is why when we're talking about the next big thing, for us, it's not about tech. And this, I think, is going to be part of the rotation story that emerges this year, that people are going to start reassessing where is the efficiency gain going to come from through the application of existing technology. Now, yes, if you're applying technology, you're buying technology, demand for tech companies, great. But the real economic gain is the efficiency of using that technology. That's where the earnings growth comes from, the cost cutting comes from. And that's going to be the next big thing. It's very, very rare that when one sector has sort of led the market and dominated for, say, a decade, that it carries on dominating for the next decade. These cycles, just the natural cycle of the way the economy works, means that you have a period of dominance and then recede somewhat into the background. And that essentially is what we think is going to be happening with tech.
Thanks, Paul. I guess, it also wouldn't be an economic or an investment discussion without a question around Bitcoin. Are those same lawyers going to come after you if you give us a view on Bitcoin?
No, Bitcoin we can give a view on because it's not an investment. It's speculation, frankly. It's a gamble. If you want to gamble, you have to be prepared to lose all of your money, and I think that's what has to happen with crypto. Frankly, I think Monte Carlo is more fun than gambling on Bitcoin, but whatever your taste. Is it a currency? Absolutely not. Now, on that, I can be quite categoric. The crypto phenomenon is designed by people who are undoubtedly brilliant mathematicians who completely fail to understand the principles of economics. The repeated hyperinflations we see in crypto. I mean, there was a 15% drop in spending power of Bitcoin last week in 24 hours. 15% drop. That's worse than the hyperinflations of Weimar Germany or Zimbabwe. I mean, that is cataclysmic destruction of spending power in a 24-hour period. And of course, if you've got a bill to pay, if you need to put food on the table, you can't say, oh, well, I'll wait a month and it'll go up. No, you need to spend the money then. And if you're spending 15% less than you thought, that's pretty bad news. So it's not going to be a currency under any stretch of the imagination. The fact that you cannot reduce the supply of crypto is something which guarantees we will have repeated hyperinflations, because we do get declines in demand for money. We had a decline in demand for dollars in August, September last year. And what happened? Federal Reserve reduced the supply of dollars to maintain the dollar's spending power. Exactly what happened. You can't do that with crypto. You can't reduce the supply of crypto. So it creates problems. What I think is interesting, since Elon Musk came out with his buy crypto story and subsequently trashed the share price of Tesla, the debate about environmental concerns surrounding crypto and its generation, because it's extraordinarily, it's toxic environmentally, that has really rocketed up the agenda. Now, sustainability for us is the absolute bedrock of the next decade. If you're not sustainably investing, you're not investing. You're just wasting your money, I think, because sustainability is economically critical. At the moment, none of the sustainability rankings pay any regard to crypto, because up until now, no sensible companies exposed itself to crypto. You can't invest in listed companies that are exposed to crypto. Now with the Tesla announcement, obviously they are exposed to crypto, and that means they're also exposed to the environmental damage that is being done. So it's going to be an interesting question as to how the ESG ranking companies change the ranking of someone like Tesla on the indices. Now, for a company like Tesla, it's not going to matter because they don't have a very high ESG ranking, funnily enough. But for some companies, this could be a major consideration. So we've now got this conflict between the sort of the hype around crypto and the narrative that comes through, and then this environmental story, which is, I think, a long-term trend, which is a dominant long-term trend. They come into conflict, and that's going to be an interesting thing to see how that plays out. One final thing, not just on Bitcoin, but on the broader situation at the moment. We have moved into an environment where the narrative becomes a lot more significant than rational behavior in the short term for a lot of different things. The way that social media is changing how we get information is very significant, because social media doesn't care about the truth. Social media simply cares about having a good story. And actually, not telling the truth normally gives you a better story than telling the truth, because the truth is always a little bit dull. And we've seen this. So around the pandemic, for example, what I think has really exaggerated the economic impact of this pandemic, given the fact that fear is one of the dominant characteristics, is, of course, the fact that this is the first pandemic of the Twitter era. And fake news has been spread all over the place, very alarmingly in some cases. If we look at politics, you look at QAnon, for example, in the United States, and some of these truly bizarre conspiracy theories that are coming out, and yet it's all being spread around by social media. The Reddit-inspired moves in financial markets, we're going to take on hedge funds. The biggest winners of the Reddit-inspired moves in financial markets were hedge funds. I mean, they cleaned up in this whole process. And of course, what I find actually quite distressing is the fact that small investors are getting sucked into this narrative, and they think that this must be right because I read about it here and here, and then they end up losing their money, and we've already seen some extraordinary human costs coming out of the whole Reddit thing, and of course out of crypto as well. Whenever a crypto blows up or an exchange is hacked, or the price drops 50% in a year or whatever it is, you get these terrible stories coming out about people who have leveraged or you've lost their children's college funds or whatever it is by being seduced by a simple, very compelling narrative which is completely fake. And that, I think, is one of the problems that we run into with the whole crypto universe at this stage, is that you get these fake stories. Harvard are buying Bitcoin. Harvard haven't bought Bitcoin. Of course they haven't bought Bitcoin, but it's a very, very common story because that legitimizes it. You can pay taxes with Bitcoin. You can't pay taxes with Bitcoin. Nowhere accepts it. Not Zug, not Ohio, no one. But it's a compelling story. And so you create these narratives and you sort of seduce people into the story, and that, I think, is something which is going to add volatility in the future, and it's something regulators really are going to have to get a grip on, because this is going to be a recurring problem in many markets, not just the fringe things like crypto, but in mainstream markets, as we saw with Reddit, and of course at a political level as well.
Well, I'm going to squeeze one last question in. I know we're running close to the time, but obviously, we were talking to a South African audience, emerging market. So something was posted here just saying, fourth industrial revolution, vaccine being dealt with in the near term, etc. A little far away from where South Africa is. Just a general view on emerging markets in all of this.
Emerging markets have good news and bad news, as I suppose everybody does. So in terms of the good news, the global recovery is something which is clearly going to be positive. We're staying in a low interest rate environment that increases the attraction of emerging markets. We're in an environment where I think it is unlikely the dollar is a strengthening currency. I think the bias is to some weakness. I'm not suggesting the dollar is particularly weak, but given the choice, it's more likely to weaken than to strengthen. All of these are very favorable for the emerging market complex, and that's going to be fantastic. The improvement in the vaccines, the rollout of the vaccines, the fact that, again, this is being accelerating, helpful. Although, of course, a lot of the vaccines are not particularly practical for emerging markets, given problems with infrastructure. The Oxford AstraZeneca is probably one of the better ones, Johnson & Johnson as well, but Pfizer is not so good because of the extreme temperatures it needs to be stored in. But again, there's a positive story there. Where we have problems near term, tourism, probably the last sector to recover. And obviously, a number of emerging markets are very tourism dependent. Remember, with tourism, of course, it's not a case of saying, well, we've opened our borders. It's got to be a two-way flow. I was having a discussion with some Greek clients recently, and they're saying, oh, well, Greece is going to open up this summer. I was like, great. What if Germany and the UK don't? Because they provide most of the tourists that go to Greece. And if we don't allow our tourists out, doesn't matter how open your borders are, you're not going to get tourists coming in. So that necessity for sort of a global opening is a challenge for the tourism sector. Food price inflation is potentially going to be an issue. We're seeing commodity prices rise. This doesn't affect developed economies because in a developed economy, food is not food. It's highly processed, very, very far removed from the farm. But obviously in emerging markets, there's a closer correlation between the prices that consumers are paying and the prices that farmers are receiving, and that's a potential slight inflation concern. Certainly it's something which may be causing some political issues. I think that's probably my bigger worry over the medium term. Longer term, with the structural change of the fourth industrial revolution, this presents some opportunities, but it also presents challenges depending on the market that you're looking at. A number of economies won the third industrial revolution by being locations for outsourcing low-cost labor, which was able to exploit the changes in global supply chains. I'm reversing most of that over the next decade. And so that, I think, is potentially troubling. Whenever Indian Prime Minister Modi says, India is going to be the next China, I wince, because no one's going to be the next China. China's growth model no longer works. And if you think you're going to achieve economic success by becoming a low-cost labor outsourcing manufacturing hub, then I think that that's a policy that is not going to win you any favors. And in fact, you're going to be investing in quite the wrong things. So I think that there are a lot of challenges on the structural side for those economies that have been particularly successful over the last 20 years. We've now got the very painful recognition that that model no longer works. And that's a transition that we're just beginning. And it's something I'm going to be spending a lot of time over the next few years monitoring to check that we continue to move in the right direction.
Paul, thank you so very much. Very insightful as always a lot to learn. Before we close off though, I'm going to hand over to Donovan Guggenheim, who's also on the call. He's the head of business development and financial intermediaries for emerging markets for UBS, and he would just like to close off.
Thank you very much, Errol, and thank you very much, Paul. We are very happy to bring you back, Paul, to South Africa and to SASFIN, this time virtually. And it's that, Paul, consumers adapt, and also we adapt from our end, making these conferences now possible, let's call it virtually. I'm happy really to be the representative of UBS to SASFIN. Since we actually started our business cooperation more, I would say that 10 years ago, it's a story of real great trust and great success. And I'd like really to thank you, SASFIN, for being with us all these years. And I'd like to thank you, to all the audience, also for being with UBS. And we also appreciate your long-term trust in our institution. Because UBS is not just a bank. I mean, what we want to be in the end, we are a solution provider. We bring solutions, knowledge, and expertise to you. And by doing so together, SASFIN has all the accesses to this information and to these people. We consult and exchange on a regular basis on these ideas. And in the end, this is for our clients the big benefit they have, to have a local specialists who are an expert in South Africa, supported by a global financial institution, and bring together, in that sense, that knowledge and insights. So I look forward to the coming years of mutual cooperation. Thank you, everyone, for arranging that, and thank you for having us on this conference.